Hi and welcome to our course on building a diversified portfolio. The first step in building a diversified portfolio is to determine your investment timeline and risk tolerance. And to start that, you can ask yourself the following question. How long do you have left to live? While it's a pretty crude question, it does in large part align with the level of risk you can take, as it determines your investment recovery time if your investments fall in value. And alongside this time frame is your personality and how you feel about risk. Are you comfortable with some calculated risk, or does risk completely terrify you? Standard Life, their website, has a handy risk questionnaire that walks you through this. And it's free and it's anonymous and it gives you an idea of your risk tolerance. And the link to that is on the screen there. And also on the screen is the ESMA risk weighting scale. Structured investment products in Europe are required to have a risk score attached to them. So this is based on the ESMA risk rating scale from 1 to 7, and most investors are in around the 4, 5 or 6 level, and if you're retired you're more likely to be 3, or if you're in early retirement maybe a mix of 3 or 4, if you're in late retirement you might be a mix of 2 or 3. And these risk ratings relate to the level of volatility inherent in the type of investments. For example, government bonds would have a lower volatility than cryptocurrencies. So when you're picking investments and stocks, you can screen for stocks volatility criteria to limit the results to within the risk parameters that you're comfortable with. And the objective of all of this exercise is to achieve a point where you can sleep soundly at night regardless of what the stock market is doing. Once you've figured out your risk profile, you now come up with an asset allocation. This is your weightings of stocks, bonds and commodities that go into your portfolio. All portfolios should have the same elements with the weightings adjusted to suit your personal risk tolerance. A conservative investor might be 40% stocks, 50% bonds and 10% commodities, for example. A moderate investor might be 60% stocks, 30% bonds and 10% commodities, and an aggressive investor might be pushing it to 80% stocks, 15% bonds and 5% commodities. Something in that type of a range. You can see the way the weightings change there. But the key is that the mix does most of the heavy lifting, and studies have shown that asset allocation accounts for roughly 90% of your returns over time. So you're not picking individual stocks, you're building a balanced framework, and if you get this right, the rest becomes much, much easier. So now you want to diversify across sectors and industries. So let's say you've decided on 60% equities, which is great. But you don't want to put all of it into technology or banking or whatever industry. You need exposure across sectors: technology, healthcare, financial, consumer goods, industrials, energy and utilities. Diversifying by sector means when one industry hiccups, others are typically humming along. You're spreading your bets. A downturn in retail doesn't necessarily hurt your healthcare holdings. And think of it as not having all your eggs in one basket. You also have to diversify by geography. And if you're an Irish investor with only Irish and UK stocks, you're missing about 80% of the global economy. You need exposure to North America, Asia, emerging markets, and Europe beyond Ireland. China and Asia are where the growth is happening, and Europe has solid companies. The US remains the world's largest market, but the US dollar is falling as US debt rises, which is eroding gains made on US dollar denominated investments. Emerging markets can be volatile, but offer long-term potential benefits from a falling US dollar. The trick is you don't need to be an expert in Chinese markets. That's where the ETFs come in. But more on that in a moment. Geographic diversification protects you from betting everything on one economy's future. Next up is commodities. And these are your portfolio's shock absorber. When stocks get wobbly, commodities often hold steady or even rise. Gold is a classic hedge. It tends to shine when confidence falters. And copper, it's the metal of growth. Infrastructure, renewable energy, AI infrastructure, it all needs copper. And energy is essential given the demand expected to power AI. Nuclear power is becoming central to AI's power demands, with 70 nuclear plants under construction globally, another 110 planned, and 300 more at proposal stage. The vast majority of these are in Asia, suggesting that this is where future growth will be. Using ETFs is the best way to add commodities to your portfolio, and in doing so, you are adding stability. The global macro view is the backdrop to your portfolio. Where in the economic cycle is the world's economy right now? As the US is the dominant player in the world, the trend in US inflation, unemployment, interest rates and exchange rates all point to where the economy is heading next, and consequently where stock prices are heading. Geopolitical issues also need to be considered. The rise of right-wing politics plus the war in Ukraine has resulted in less globalization and Europe deciding to rely on itself rather than US for protection and Russia for energy. This type of major shift creates investing opportunities. The rise of China and Asia in general, bringing billions of people out of poverty and into the consumer economy, also creates investing opportunities. So look beyond the main US stocks and invest globally. So now we get on to using ETFs. So don't try to buy Chinese or emerging market stocks individually. The regulatory environment is complex and most stock platforms won't have access to Asian or South American stock markets. Instead, select ETFs focused on those regions. One purchase will give you instant diversification across dozens of companies. The same goes for commodities. A gold ETF gives you exposure without dealing with physical storage. And a broad emerging markets ETF captures growth across dozens of countries. ETFs are cheap, they're transparent and liquid, and you can sell them instantly at any time. And remember, there are highly skilled investing experts employed by Wall Street investing firms to carry out all the research, pick out the best stocks to include in their ETF baskets. So you can use just ETF.com as a screener to find the best ETFs for your portfolio. Bonds give your portfolio stability and income. You can buy government bond ETFs for broad exposure in this asset class, and some investing platforms will give you access to buy bonds directly. This is important as the gains from bonds are tax-free, but gains from ETFs are not. So how you purchase your bond is important. StateSavings.ie lets you buy Irish government bonds directly. By doing so, you're supporting Irish borrowing needs and you get a known safe return. These rates aren't spectacular, but that is really, I suppose, the point of bonds. They aren't meant to generate excitement. They're meant to be dependable. And a mix of ETF bonds and for diversification and perhaps some direct Irish government bonds gives you solid peace of mind. So now we move on to adding cryptocurrencies to your portfolio. So the first step is you need to decide if you believe the crypto story or not. So you can watch the IIFT video on cryptocurrencies, or you can also complete our 3 IIFT long courses on crypto to get a good understanding of what this type of investing is all about. So if after all that you decide to invest in crypto, you should set aside up to maximum of 5% of your portfolio for crypto and stick to the coins that have some real underlying business case. Also consider including stocks operating in the crypto and blockchain space to broaden out your crypto play. Markets don't stand still, as we all know, and after a strong year for stocks, your portfolio might have drifted from 60% stocks to 70% stocks in weighting. So now you're holding riskier assets than you've intended, meaning that it's time to rebalance. So you should sell some of your stocks and bring that weighted balance back to 60% stocks or wherever your weightings were at the time you set your risk tolerance. So without rebalancing, your portfolio can slowly transform into something you didn't plan for, and you might not notice until markets fall and now you're in a position where you can't sleep at night. So use stock screeners like FinViz or Market Screener or Yahoo Finance to find suitable stocks that are really high quality companies, and you can use justetf.com to find ETFs that are UCITS regulated, and this will help you select stocks to rebalance and rework your portfolio. There is a saying that the financial markets are there to make money from you and not for you. And the way they make money from you is by charging you fees. So fees are a silent killer to your stock portfolio. A 2% annual fee might sound that it's not bad until you realize that over time it can reduce your return significantly. For example, if a 50,000 investment doubled over 20 years, a 1% fee would result in €17,000 higher return than a 2% fee. So you want to use low-cost ETFs. Many of them charge less than 1%, 0.3 annually would be a good price. You want to stay disciplined and don't panic, sell in crashes, and don't chase hot stocks and tips that your mate down the pub might have given you. Your diversified portfolio is designed to weather storms, so you shouldn't have to keep chopping and changing and buying and selling. And the investors who win are those who stay the course and keep costs low and let the compounding do its thing. It's simple, it's boring, but it's very, very effective. So now, you should now have a solid, well-diversified portfolio reflecting regions of the world where growth is powering ahead, made up of high-quality companies that will still be market leaders in years to come, purchased through a mix of direct holdings and holdings via ETF, and balanced by in-demand commodities and anchored by government bonds, and reflecting a risk weighting that allows you a decent annual return and, of course, what we all want, a good night's sleep.